Testing 1, 2, 3. All right. Look at these markets drop already. I apologize for the little bit of a late start. I had some technical difficulties. I had a cable come loose. I couldn't identify it. Where in the heck was that cable that came loose? So finally got it figured out. And man, look at that market flushing like a toilet. Holy cow. Makes you think there's some news out there, right, that you're not aware of. So you bring up the news and you're like, wait a second, there ain't no bad news. 6:30, 7:30, 6:30, that was a while ago. Maybe that's what they export prices shot through the roof. Export prices shot through the roof. Bad news all the way around. Every day we're coming through with more bad news. New York Empire State Manufacturing Index. Manufacturing went way down. Oh, that's probably it. Actual right there. That was at 6:30 this morning, though. What time is it? What time did that flush? 5:30. 6:30. Started to flush right here at 7 o'clock. But the thing is, 7 o'clock, 7:15, industrial manufacturing came in. But that was 15 minutes later, and that was pretty much unchanged. We just had a bunch of bad news on the prices of imports. 8 o'clock, we got the consumer sentiment. What do you think that's going to be? Really high? Could be. Look at that. Consumer sentiment. Michigan consumer sentiment. I don't ever trust that thing. University telling us whether people are happy or not. 76 forecast 76.9. Senate consensus 76.9. Previous 76.9. So probably come out 76.9. All right. Markets are going crazy. 7:30. What time is it? 7:30. Okay, this is the opening bell. This thing dropped like a rock and starting to bounce back. Let's bring this thing up a little bit full screen. Get me out of the way. See what's going on. We're going to, in light of our conversation yesterday, we're going to kind of try and focus in on one chart and not be so myopically focused on just the 1 minute indexes. So we're going to come down and we're going to choose the Russell today. And we're just going to kind of focus in on the Russell. Where is my Russell? It's 13, isn't it? Oh, that's a mini S&P. S&P, we ought to do some options on this thing. But we'll do some more options next week. We start our options class at the university on Monday. For those of you who are able to attend, I'm looking forward to meeting you in person again. Meeting with you in person. We got a pretty good class, already all registered and signed up. Where's my Russell? I thought I had just a mini Russell in here. Can you guys see it? And I can't see it sitting right in front of my face. Mini Russell. There it is, 14. Roll it. All right. So where are we at? 15 minute in the upper left-hand corner, 5 minute. Range bar 6, 1 minute. Let's put 5 minute here, 15 minute there. All right. So the longer term trend all night long went a little sideways. And on the 15-minute chart, we had the big drop yesterday. And then it just went sideways. And now it looks like it had a big drop this morning, but now it looks like it's rebounding. It's trying to rally a little bit here. Have a little bit of a rebound on these small caps. Now remember, the Russell is small caps. I had a question today. Yesterday, actually, come in on the YouTube question thing. Oliver, I think it was asking. He says, "Hey, Lane, you don't trade with the dome. I watch this guy on another channel, and he likes to trade with the dome. He trades with the dome all the time. And you don't trade with the dome. Why don't you trade with the dome?" Well, Track and Trade has the dome. If you come in here and you go view and you turn on the dome, show dome tab, and you got the dome over here, I just don't like it. I was never trained on it, never use it much. It's kind of the old-fashioned way of doing things. This price table down here along the center is your price table here on the right-hand side of the chart. And so it was developed back in the days before you could draw on charts, and before you could place orders and drag and drop orders on charts and stuff like this. So what happens is you drop your order on here and see it shows up over here. And it shows that you got one order. See that right there? That little number 1 right there. So, oh, you got a contract on there. And the way you place orders on the dome is you click on the dome and it pops up, little things like this and let you place orders on the dome. And of course, you can say, don't show me that again, and just place right off the dome without having the pop-up. But you click on the red if you want to take sell positions, you click on the green if you want to take buy positions, et cetera, et cetera, et cetera. It's kind of the old-fashioned way of doing things. So I don't use it. I don't like the dome. Don't use it. I like the drag and drop. It's not one is good, one is bad. It's just personal preference. If you like the dome, trade with the dome. It's kind of, like I said, it's kind of an old-fashioned way of doing things. It's before we could drag and drop orders. Gecko Software, Track and Trade was the first company to ever have a drag and drop orders. We basically, you could say, we invented them. So now, most software programs have drag and drop orders, and they no longer use the dome. But there's still guys who like the dome. I'm not saying it's bad. You can use the dome. And then a lot of people are like, well, I want to see the depth of market. Well, the depth of market, it can be helpful, but you have to also remember that it's also spoofed a lot. And so you have to be careful. A lot of guys will go, oh, I'm going to go buy because there's a whole bunch of buyers up high, or I'm going to sell because there's a whole bunch of sellers down low. Market's going to go down and fill all those orders. Well, most of those orders that are sitting out, those great big huge lines of great big 1,000-piece orders, those are spoofs. They're fake. They're not real. They've been put there by big players to draw retail traders who don't understand how markets work, to draw retail traders in to think just like that. Oh, I'm going to buy because that market's going to go up to those big orders, and I can see them sitting up there. And then as soon as the market gets up there, poof, they disappear. They're gone. Why? Because they pulled them off. Because it's fake. Because what they do, these big players, they can hide their orders. They have hidden orders. So what they'll do is if you see the big players' orders, like 1,000 shares sitting up there, it's because they want you to see it, because they can hide their orders and not show them up on the dome. So what they'll do is they'll take a short position here and put a long position there. They'll let you see the long position, but not the short position. So what you do is you're like, oh, well, we're going to buy it, buy. So all these unsuspecting retail traders buy, try to drive the market up because they think that there's this $1,000 buyer up there that's going to shoot the market higher. They drive it up, and then the guy hits the sell signal that's invisible that you can't see, the hidden seller, and then he removes this one and flushes the market down, and that's how he makes all his money. That's how these large institutional traders or hedge funds do it. So there's a lot of spoofing going on, and so you don't know what to trust on the dome by watching that and seeing, oh, there's lots of big, huge buyers up there. Well, they're probably really not. They're probably spoofing you. And so you got to be careful with that. And that's one thing. And if you understand the dynamics of markets, you know where all the liquidity is anyway. You know that people like to get in on a break above a previous high, right? So if they get in on a break above a previous high, well, where are they going to place their stops? They're going to place their stops just the area of support below it. So there's going to be a whole bunch of liquidity right there. You just know that. You don't need to have the dome tell you that. I mean, it can help you, but the problem is that most people use the dome to try and see these great, big, huge orders, and most of them are spoofs anyway. So I don't know. I just don't use it. I know where markets are breaking and trending and where people are going to put their stops. And there's an article in Pit News Magazine this month about gunning for stops. You guys are all going to love it. It tells you all this stuff that we talk about in this class. So, the dome is there in Track and Trade if you want to use it. I like to use this little mini chart up here in the top right-hand corner. You hear me say that all the time. I'm like, hey, I'm watching the little mini chart. What is the mini chart? Well, it's basically the volume of the dome. So you take that volume that's in the dome, and it's the actual trades that go through, not the spoofers, not the fake ones, not the limits, not the stops that they're letting you see, because they can hide their orders on there. You hear them talk about that all the time in these other channels. Oh, there's a hidden seller. Must have been a hidden seller because the market just flushed and there was nobody there. It's a hidden seller because they're spoofing you. Okay, they can spoof. If you don't know what spoof is, go look it up. You can go do a little research and find out what spoofing is. All right, that's what's happening on the dome. It's not the reason I don't like the dome. I like some respects of the dome. I just don't like trading with it because it's kind of a disconnect. It's like, okay, my price scale is over there on the right-hand chart, side of the chart, but my chart is over here, and the action is happening over there, and it's kind of like a disconnect. So when we connected the ability to trade, we kind of put the dome on the chart. And so that's what this is, because you're placing your order. This is kind of like what you do on the dome, right? You place your order, you pick your level on the dome. The difference is that on the dome, you don't have areas of support and resistance that you can draw your lines against. That's why we have that horizontal line in there. So you can come in here and say, oh, well, there's a horizontal area of resistance. Here's a support level. And I can draw it on there. And I want my order to be right underneath that level of support or right above that level of resistance. And it's really hard to do that on the dome, because you have to sit there and look at price, not at ticks on the screen to find out where support and resistance. Oh, it's 2064.20. So then you have to come over to the dome and you have to find 20.64. And I'm not very good at remembering, so then I have to come back and look again. Oh, now wait a second. 2064.40. You come over to the dome. You say, I want to put my stop order on 2046.0. And it's just a lot of disconnect, and it's really slow, in my opinion. That's why I don't use the dome. Not that I don't. Again, different strokes for different folks. And I know there's some great traders out there who use the dome all the time, and that's perfectly fine. Go use it if you love it. I'm not telling you not to. I'm just saying it's old-fashioned technology before we could actually drag and drop orders on the screen. And you can just drop it like that. That's the same thing as the dome. It's just you have more accuracy, quicker, faster, easier, and in my opinion, I like it better. Are there advantages to the dome? Yeah, there are. I mean, if you view the dome again, if we turn that back on, the dome has kind of all this little volume stuff over here, which is kind of cool. It shows you where all the trades have been active and where the markets have been active. But is that really helpful to you when you're looking at trying to get into a market? Yeah, I guess, you could say that's helpful, but let's come back here. I don't want to view the dome. It takes up resources too. So I'm more interested in trading on the chart, which we've kind of, again, put the dome on the chart. So now you can place your orders right on the chart like this. Okay. And that's the same thing as the dome. You're just not clicking a little red square over here in the control panel on a price level that you've determined. So in the dome, you'd have to basically come over here and draw a trend line, and you'd have to say, okay, I want to put my stop right here, and that's 2063.4. Then you'd have to come over to the dome, find 203.64 on your dome, and then you'd have to click the order to place the order. So just a little bit different process, a little bit slower in my opinion. So I don't like the dome. I don't use it. And I use that little chart up in the upper right-hand corner because that's the time and sales. So a lot of times you'll hear these guys start yelling, there's green on the dome, there's green on the chart, there's green in the dome. What that means is there's lots of buyers. And so when you're looking at the dome, when you see that, there's green on the dome, there's green on the dome, that means that lots of buyers are stepping in and the market's starting to rally. Well, you can see that in the chart. Lots of buyers are stepping in and it's starting to rally. Okay, so there's green on the chart, green on the chart. Okay, green on the dome. Okay, and then this is charting that. This little chart up here in the right-hand corner is charting those greens, or the reds, right? So we actually chart it instead of just see the colors. And so that's your little chart. That's your little time and sales chart up there. That's why you'll hear me say, I'm watching the tiny chart in the upper right-hand corner. I'm watching time and sales, so that I can see, and I would rather chart it than just see a whole bunch of numbers, green numbers scrolling through the screen. Now, I know it shows quantity. I know, but it's 10. It's not just 3. It's not just 1. But it's charted over here, so it takes that all into consideration. I think a chart is, for me, I like charts. It's visual, not just a whole bunch of numbers scrolling with green or red and interspersed between red and green and trying to determine that. It's just a little bit different way of looking at it. And I kind of like it better. That's all. I know that Ross Cameron, one of my favorite guys in the whole world. I love Ross. You guys have a chance to go watch Ross. I'm sure you have. He's the guy I talked about before. He likes to do pump and dumps. He's the pump and dump expert. If you like to go trade pump and dumps in the morning with Ross, then great, go do that. It's really super hard. Ask me how I know. Not that this is easy, but pump and dumps are really hard. And then he trades pump and dumps, but he uses the dome, and he's very good at it. And I like Ross a lot. Never met him. I'd like to meet him sometime, but he's a superhero in my book, and love Ross. And he uses the dome almost exclusively, very much a dome trader. So just different strokes for different folks. I don't use the dome. He doesn't use a drag and drop software application either. He can't drop orders on the screen like we can. He uses just a little website browser. Now he used to use eSignal, but he dumped eSignal and now he just uses a web browser and he uses the DOM. So I don't know. Do what you want. I'm just telling you what I do. I'm not telling you what you should do. All right, so let's watch these markets. They're starting to calm down a little bit. Let's draw our brackets in here, highs and lows. So that's kind of our morning bracket on the range bar chart. Looks like the 5 minute, the 1 minute. I'm trying to get an idea of where we think this market's going to go. It looks like to me it wants to go short. So we're going to take a short position here, and then we're going to see if it wants to fall out the bottom on this 1 minute chart. We're seeing that up here on the Russell on the range bar 6. If it doesn't fall, I'm just going to get right back out. I'm not going to take a big risk, not going to take a big loss. And so that's why I use this range bar 6 chart. You know, I get the question, why do you myopically just watch one range bar 6 chart? Well, I don't. I like the other time frames. We have to watch the other time frames for longer term trends, right? And that's the whole name of the goal. But for entry, I like these small time frames. If you go watch Ross, he uses a 12-second chart for his small time frame. I use a range bar because I think they're a little bit cleaner. The software platform he has doesn't have range bars. I don't know if he'd use them if it did, but it doesn't have range bars. He just uses a 12-second chart, which is kind of interesting. We don't have a 12-second chart. The platform he uses is a 12-second chart. I use a range bar chart. I like them better. Even if I had 12-second charts, I wouldn't use them. All right. So this is, we're going to look for this thing to come down, trail down on the ATR. Now we're coming down. We're touching the little blue line right there. We're going to probably bounce off of that. The question is is it going to continue to follow through, or is it going to bounce back? So I'm going to edit. I'm going to stop trailing right there. See if it wants to drop some more, or if it's going to come back on us. If it comes back, we'll get out. Okay, Lan, you're supposed to be trading on a longer term time frame chart. Well, you're supposed to go to the 1 minute chart. Well, if the market doesn't keep falling, why would I just say, well, I'm not going to look at a smaller time frame chart? You know, I'm myopically focused on my 15-minute chart. Now we have the same problem over there, right? We have the same problem over there that we had over here. So if you're just myopically focusing on one time frame, you don't see the small moves, but you can also get bumped out like we just did. Okay, there's advantages and disadvantages in trading everything. So we just got bumped out. Now is the market going to fall? Probably. We could have stayed in, but we got out and took our profit in case this thing went back against us. We can always get back in. We can say, oh, well, I'm going to get back in, but I'm not going to just jump in randomly. I want to make sure that I have another setup. And if the setup will follow through, then we could stay in the market longer. But we also know that the market comes down, hits this blue line, and then it likes to bounce off of that, use it as a support resistance area. If it starts to fall once again, we'll have an opportunity to get back in again. And we see that over here on the Russell on the 1 minute chart. If you draw your Fibonacci ruler over here, we're going to draw from the top to the bottom. And we're right back here in the Fibonacci sweet spot right now. So this is kind of a danger zone to be trying to take a position. It's a neutral area. So you don't know if the market's going to continue to fall through or if it's going to continue to rally. So it's starting to fall right now. Once again, you're like, Lan, you were in it from way up here and you got stopped out. Well, that's because I was anticipating the possibility of a rebound. So now there's lots of opportunities. You can get back in if you want. There was another re-entry point right there, but it was kind of right there on the blue line. Well, again, bouncing sideways. I didn't know it was going to fall. So what we're going to do is we're going to anticipate the possibility that it might continue down right here. There's not a very good spot for entry, but it's a little pullback. That little tiny green line is what we call a pennant formation, right? And I'm not going to take a big risk. If it doesn't go, I'm going to just get right back out again. So we'll just put our stop in there. And if we get stopped out, we get stopped out. But I don't want to take a big risk on my initial entry. And the other reason is, come on, buddy. It doesn't want to fall. Keep going. Nope, doesn't want to do it. The other reason is, let's go look at our spreadsheet, and I want to show you what else. Lan, trade with 15 contracts. Lan, trade with 15 contracts. I watch that guy on the other channel. He trades with 15 contracts. Well, we're doing our due. Oh, that's not what I wanted right here. We're doing our due diligence here, right? We got to come in here. If we're going to come in and start with a small account challenge, we say we're going to start with $10,000. And I know some of you guys are even starting with smaller than that, $5,000. But we started this one with $10,000, and our starting balance was $13,000 in March. So we start with January. This was our January trading, right? And so what we did is we started off with 10,000 in January, 10,000. And what that we've done is we've done the math. Okay. So we do the math. So we know what our risk versus reward ratios are supposed to be and how much risk and how much money we want to make. So when we first started off, we said our goal was to make 1%. So 1% is $100. So that means our daily max loss is going to be double that, $200, because we only want to have, if we lose $200, well, we want to stop trading, because if our goal is to make $100 a day with a $10,000 account, which is 1%, then we don't want to take more than 2 days to make back the loss, right? We don't want to lose more than 2 days loss. That's kind of the idea. If you're fine with a 3-day loss, you can go ahead and stick that in there, and you can say, well, I want it to be, I don't mind if I lose 3 days. Okay. Now you can risk, right? You can risk a larger amount. So now you can say, well, I can lose 3 days worth of losses. I'm going to be willing to drop down to $300. And if my goal is $100, it's going to take me 3 days to recover it. I like generally 2. I've seen some other guys who do that, and that's kind of a good number. And I also see some other guys do bigger numbers here. Ross does like a 5%. He'll put like 5 or even 10%. I think sometimes Ross puts 10% right here. So if you're going to put 10%, depends on the size of your account, right? If you're going to try and make 10%, well, your daily loss is $2,000. That's a pretty big chunk of money coming out of your $10,000 if you're allowing yourself to lose $2,000. But you got to now your goal is to make $1,000. You can lose $2,000. You're going to want to trade with larger size, because our experience tells us that when we're trading with one contract, right? Because we're small traders, we're just getting started and we're new, we trade with one contract. Well, one contract, it's pretty tough to make $500. If you're trading with 2 contracts or 3 or 4 or 5 contracts, making $500,000 is not that hard, but it's also a lot easier to hit your $2,000 loss as well. So it's all relative, because it's all a mathematical model and all a mathematical calculation, right? And so you want to come in here and do what's right for you. So I'm trying to make it easy on us, because we're new traders, and I don't want to have lofty expectations that you're going to come in here with a $10,000 account or a $5,000 account and start trading with 15 contracts and be rich, rich, rich beyond your wildest dreams, because you're not. I can promise you, if you come in here with a $5,000 account and you start trading wild man like that, you're going to just blow your account up. It only takes one bad trade. You know, we always talk about one good trade a day. That's all it takes, is one good trade a day, and you're going to be rocking and rolling. Well, it goes both directions. It only takes one bad trade a day to blow your account up if you're going to trade like that. So you still want to be very cautious, very careful, run your risk management strategies. And as you gain confidence and gain money in the markets, now we go to February, see, the numbers start to increase. Now we had some bad days, so the goal decreases. Oh, now you've lost money, Lan. You had a bad week. You had a big loss. Okay, now your 1% is no longer $100. It's now $78. Well, then we had a good run. We had some money. We made some money. Look at this. Now our daily goal, as still at 1%, is now up to $135. That means our daily max loss goes up to $270. So these are not fixed numbers. They grow with your growth. As you grow as a better trader and as you get more money, your daily goal is going to automatically increase, and your daily max loss is going to also automatically decrease. And at some point, you're going to have to trade more than one contract. You're going to start seeing, hey, wait a second, I'm not able to reach my $200 a day just trading one contract. I'm going to need more contracts to do that. And you get more confidence. You start doing basically the same thing you're doing. You just double up on your contracts or triple up on your contracts. All right. So it's all a mathematical model. This spreadsheet is available to anyone who wants it. It's free. All you have to do is go subscribe to Pit News Magazine. I guess it's not free. It's $1. I charge $1 for it. You have to go subscribe to Pit News Magazine, and then you get this spreadsheet. All right. And you can build your own spreadsheet. Go ahead. But for $1, you can go subscribe to Pit News Magazine, and you can get it for free. Or you get it for $1. But you also get Pit News Magazine. So is it free? Not really. You have to pay $1. And why do you have to pay $1? Well, because you get 3 months of Pit News Magazine for $1, and then after that, Pit News Magazine. Where is Pit News Magazine? I guess I don't have it up today. So Pit News Magazine gives you the ability to get that for the first 3 months. It's $1, and then it's $49 for an entire year after that. But you get the spreadsheet. That's a free gift if you subscribe to Pit News Magazine. So go get the Pit News Magazine. You have all these formulas in here for you, and you can work this all out yourself. All right, for your own love of trading. All right. So let's see what we're doing now. The little marquee out front was on triangles and wedges. And I wanted to talk about triangles and wedges today. And triangles and wedges are times when markets have a tendency to go sideways. They're kind of neutral markets. Okay. So I have down here, I have my, oh, there's our Pit News Magazine thing. But I have my spreadsheet here, and I want to talk about triangles and wedges. Okay. Now, in this example, you can see, oh, where did it go? That was a mistake. That's not what I wanted to do. Hold on, Lane's having technical difficulties again. You're not very good at this. Trying to grab it and bring this on screen. So this is a little triangle, all right? It actually just looks like a little pullback, the hedge fund pump and dump. So what happens is markets have a tendency to rally really hard like this, and then they pull back, have this little pullback, and then they rally once again. Now there's two different pullbacks in here. See this little pullback right here, or this green bar? You can see my mouse on this one over here, so hopefully this is better for us. See that little green bar right there? That's our initial run, right? So if we come in and we go to this one, this is what we're generally looking for, right? We like ABCD patterns. So a market has to be relatively going what we call parabolic to get these types of patterns. You need a market that rallies up and pulls back, and then it starts to rally once again. So we look for that first green bar or the first break of a new high, right? The markets are higher highs and higher lows, and lower highs and lower lows. That's what makes a market bullish or bearish. If it's making higher highs, then it's bullish. If it's making lower highs, then it's bearish. Okay. But when a market starts to go sideways, it starts to go into these little neutral trends. Now, sometimes there's narrow sideways channels where the market just kind of bounces up and down in the areas of resistance across the top and the areas of support across the bottom, or horizontal, right? They're just straight across. But that's not usually what happens. What usually happens is that the market will come down into these little triangles or wedge formations, where we'll have a little pullback. So we'll have lower highs and we'll have higher lows. And that's a little triangle or a wedge formation. Now, if you come back to the initial pattern here, nope, this one right here, you can see that the bottom is kind of flat. I got a flat line drawn in there, and then you got a top line. So this right here was our initial first. Oh, you know what? They give me little pencils. Let's try this. I think I can. How's this work? I practiced with it the other day, and now I'm still not very good with it. So much for my practicing. There we go. See that little right there? Now I'm going to draw on it, not know how to get it off. Now how to get it closed. Okay. I guess you have to leave it open. Okay, so we got this little bar right here. I'm trying to bring focus to this little bar right there because it's the same little bar as what you're seeing right here in this pattern. So this market took off and went parabolic up, right? Well, this one did not. So when we come down here, it didn't take off like we anticipated. We expected it to come here. Well, it didn't. So what happens is you draw a trend line across the top of that bar like that, and then the next one is your next little arrow, and that's called that's a wedge, okay? So a wedge formation is still a continuation formation. So what happens is the market comes up, it comes down, and it doesn't go parabolic. It doesn't go shooting right straight back up again. Comes down, creates this little wedge formation, and you can draw a trend line down there. and it becomes a triangle or a wedge pattern. And then the breakout comes in right here. Now, oftentimes we'll wait for it to break above that green bar rather than at this location here because it's a little safer, I guess you could say, safer, but it's also a larger risk. Now, think about this. If I wait for it to break above that first green candle right there, I'm going to put my stop one price bar back, which is going to be down to this level here, right? So if I get in early, if I get in right down here when it breaks the natural trend line, I'm still going to put my stop one price bar back. And then I'm going to have my entry is going to be here. So my risk is actually smaller by getting in earlier. So guys will get in earlier so that they have a smaller risk. Now, the problem with this is everybody puts their stops at the same location. They all put their stops right there. All right. And so the problem with that is I've learned how do you, oh, all those things are still there. Okay. So the problem is everybody puts their stops at the same place. And so that's what causes these markets to do these little flip-flops, come down and then turn and rally once again. They're gunning for stops. All right. And again, Pit News Magazine, January, February, March, April issue. I have to count on my fingers. April issue is going to have an article about gunning for stops. And you can see that actually right here. See this? Market rallied up. It popped down. It gunned to your stops right there. See that? We call that the spring where it pulls back because that's the spring. So the market pulls back, guns everybody's stops. That's what it's doing. It's the market manipulators coming down. I call them what do we call them? The linebackers. The linebackers come down and tackle everybody, take you out, only to let the market rally once again, right? So you got to be mindful of that. And that's why this right here is what it is. So you get this first run, which is, well, I'm going to put my order in like this. So we get guys starting to take the green run, and then they come back and they take out all your stops, which were set back in here. So they take out your stops and then they go on the second one, which is what causes this little triangle or wedge formation. So the point that I'm trying to make is I want you guys to all start thinking your brain you have to think it in two ways. You have to think as if you are an offense and at defense at the same time. It's like playing football. What is the offense going to do? The offense wants to take the ball up the field, and the defense wants to push you back and tackle you behind the line of scrimmage. And so when you think about it as the line of scrimmage, I mean, I'm not doing this. I'm not playing this football game concept just because it's funny. I'm trying to get you to think like an offense and like a defense at the same time. What is the offense going to do? What is the defense going to do? The defense does not want you to make money. They want to fill your orders. And your order, if you put a stop down there, they're going to go down there and fill it for you. Okay. That's going to stop you out. That's how they make their money. They make their money by filling your order. Now, they don't know if you make money or lose money because there's going to be a lot of guys that'll put stops on there to take a short position, right? They're going to take a short position off of that break right there. And so the linebackers, as we call them, which are the market makers, they don't know that if they fill your order, whether you're going to lose money or make money. Now, it's not a human. It's a machine. So all these people are freaking out about AI. Oh my gosh, AI is going to kill the financial markets. It's going to destroy trading. Trading will never be the same. And you'll just come in and push a button and AI will trade for everybody and nobody will make any. That's such a crock of that's such a crock of You said it, not me. All right. Why? Why is that a crock? Because we've been trading against AI for 10 years or more. These things are all algorithmed out right now. We've been trading against computers for years and years. So it's not a human that comes in and says, oh, there's stops down there. I'm going to be a linebacker today and go tackle those guys. No, it's a computer that does it. Computer's been doing this for years. They've been programmed to do this for years. We've been trading against algorithms for years. It makes it hard to trade in one sense, but it also makes it very easy to trade in another. And you have to think about it from both sides. Algorithms are smart because they can see your orders. Yes, they do have that ability. They can see orders. They have to be able to see them because it's their job to fill. All right. It's their job to fill. So they have to see where the orders are so that they can go fill them. And they push the markets around. That's the problem, is that they have the ability to, not a lot, but within a range, they can push the markets up and they can push the markets down. And then, of course, large speculators. If you watch the last month's issue of Pit News Magazine, we had a video of Jim Cramer, right? And Jim Cramer came in and he told us that, hey, large hedge funds, they manipulate the markets. They'll come in and spend $10 million and push that market to where they want it to be. And then they'll pull their support out, flush it back down, and make all that money. And that's another pattern that we actually look for. So you look for that pattern. And here's a very good example of what that pattern might look like. It's a strong rally. And sometimes it's just a single big bar. You'll see sometimes just one big bar. And then the market will go sideways like this, just goes like this. And then suddenly it flushes back down. That's usually manipulation. All right. That's a manipulated market when you see that happen. Now, if you were to look at a range bar chart, we break those big bars up into smaller bars. And the reason we do that is because it makes it easier for us to trade and execute our positions, right? So think about this. If your software is designed to give you a new signal at the end of every price bar, okay, the bar has to close before it can give you a signal. So let's blow this up and look at it, because I want you to understand this. It's really important. I know it seems technical and it seems like it's not the fun stuff, but it's the important stuff. This is a crossover of your green bars right there. There's your signal, right? Let's draw a line across there. There's your signal. That's your signal for entry to the short side. But there's your arrow. Now, an arrow doesn't come in until the close of this bar that it's pointing at. Why? Because it's the mathematics of that bar. All this bars from here to here, from here to here. That's the mathematics that created that arrow. All right. Everything that's in those bars is the mathematics that created that arrow. That's why you point at the last bar of the mathematics. So what happens is you can't get in until the close of this bar, which creates the next bar. And in this case, the close of that bar was right here. Now, I know it doesn't look like a big difference, but that's because we're using small 1-minute charts. But the difference between this green crossover and the close in this case, that's $90. That's $90. All right. Now, if you do that on both ends, you're like, well, here's your exit signal right here. Okay. So here's your exit signal right there when it crossed that green line, but you can't get out until the arrow comes in at the close. There's another $90 on the other side. Okay. So now you're losing $90 off the top and you're losing $90 off the bottom. What happens is your profit box is what we call it. The distance between where you can get in and where you get out is little tiny. It's like that big. All right. So here's your entry. Here's your exit. There's your profit box. So on this trade, let's get rid of all these drawings. In this trade right here that looks so good and so beautiful, and you're like, oh my gosh, look at that. From top to bottom, that was $700. Well, how much of that could you have caught trading the arrows? Well, you get the profit box. You get from the low of this bar, which is the signal bar, to the high of this bar, which is the signal bar. So your profit box is right there. That's your profit box of that trade right there. And people don't understand that. And that's what causes, that's $85. $85 is your profit box out of $690 move from top to bottom. All right. Move from top to bottom. $690 move. Your profit box from arrow to arrow was $85. And if you didn't execute perfectly, it's less than that. Lots of silence for dramatic. That's a dramatic pause. All right. Dramatic pause while you think about that for a second. Let's do another one, another profit box. Just trade the arrows, land. Just trade the arrows. Now you know why I don't focus so much on the arrows. I use the arrows not as buy-sell signals. I use the arrows as indications of the market being bullish and bearish. Because if you're trading just the arrows, you're trading the profit box. Here's another profit box. Here's the crossover. Here's the arrow. There's your entry right there. There's your exit right there. So there's your profit box. So here, from bottom to top, all the way up there, that's $995. But if you just traded the arrows, entry on arrow, exit on arrow, and you were perfect execution, no slippage, your profit box was $170. It's not bad. At least it's a profit, right? It's a profit. Let's go look at some other profit boxes, shall we? let's go look at this one. From here, this is your entry and this is your exit. Where's the profit box on that? Well, you come in here and you got in right here and you got out right there. So your profit box was a negative $215. Negative $215 negative profit box. You lost money on that one from there to there. But if you look at the crossovers, you'd have got in here, right? Or close to it, and you'd have got out right here. So there's your loss box or your profit box, which is in this case still negative. But at this time, if you did it from crossover dots to crossover dots, that's your profit box. And the loss on that one was $50. Okay, so that's the difference. That's you got to think about those things. That's why I use the QOCOs and I come in and I trail them on either one price bar back if I'm being more aggressive, or I trail them on the green dots. It's to bring that profit box in, because this is our arrow. This was our crossover that caused that arrow. We can't get in until the end of the box. That means in this case, this would have been our entry point for the short side right there. And this would have been our entry point for the short side had we taken the crossover on the arrows, on the dots. Now, there's an advantage and a disadvantage to taking the first crossover. If the market's going sideways and it's not trending, we get lots of little stabs. I call them little stabs, where they take their steely knives, right? And they stab those green dots and then they turn and go up. So by taking the very first stab is also a little bit dangerous as well, which is why if you're going to do it, you have to be very careful with your stop, and you have to put a stop right behind the market. I will usually put it even right on the bar itself for the first entry, because I'm being very cautious. I don't want to take a big loss. These markets are big. It's $50, $60. You do that 6 or 8 times, you're down 1,000. You can be down $500 really fast. So you want to be in a market that's moving and shaking. You want to be a market that's in an extreme high or low. That's why we use these indicators down here. We look at stochastics indicator, and we want to make sure that we're only taking crossovers of those green dots when that stochastics indicator is way up there in the top above that 80 range, right? We're way up there. This is where you do it. Or way down here. This would be another place where you could take a long position. And then you're going to trail up on those green dots. And if the green dots stop you out, well, you get stopped out. It could also be a reversal on the green dots if you wanted to. If you want to swing trade. Now, I know a lot of people use swing trading in the wrong form. They say swing trade, and then they mean, I'm trading out in the stock market on a daily chart for months and months holding. That's not swing trading. That's position trading. Stop using the wrong terminology. Swing trading means you buy and then you sell, and you buy and you sell, and you buy and you sell, and it doesn't matter the time frame. You can swing trade on a 1-minute chart. You can swing trade on a range bar chart. You can swing trade on a daily chart. If you're buying and selling and buying and selling and buying and selling, that's swing trading. Kind of makes sense, right? You're swinging. Get it? Swing trading. I don't know how that ever got screwed up and people started using the wrong form of that somewhere but everybody does it. I see everybody say, I'm a swing trader. Okay, what does that mean exactly? It means I go out and take a long-term position and hold it for months on end. No. I guess you can swing trade that. Or are you going to take a short position when it goes short? Oh, no, I only take long positions, but I'm a swing trader. Well, don't call yourself a swing trader if you're not swinging with the market. You're a position trader. You're taking a position in the market, bullish or bearish. You're holding it. I don't know. That's one of my pet peeves. I wrote an article for Pit News Magazine about all my pet peeves. And then I didn't publish it because I was like, what the heck? Man, get off your pet peeves. Let people do what they want to do. All right. Back to trading. This market's dead. See, the stochastics indicator is dead center. It's inside this box here. So if the market is inside this box here, it's dead, not trading. It's not in an extreme high or an extreme low. So you probably don't want to be taking positions. But I got a buy arrow land. It could be a breakout. Well, I call that an A1. For those of you who are familiar with my book, not that I'm touting my book, but I'm touting my book. Shameless plug. Go get it. This book right here. It's out on Amazon. All right. It tells you what all the probabilities are of all these different patterns. Okay. So out here in this book, you can go get this, and it's going to tell you an A1 is an extremely low probability of success. Why? Because it's the first breakout, and first breakouts, as you can see on the chart, first breakouts, they fail all the time. We have lots of failures on the first breakout. Okay. Every single one of those first breakouts, those were all A1s. They all failed. So what we do is we wait for an A2, if you want to take an A2, which this would be an A2 right here. Okay. An A2 is when the market breaks out, gives you an A1, has a small pullback, gives us a little wedge pattern, triangle, pennant formation, like on the marquee, and then it breaks a new high and starts to rally once again. That's an A2. So an A2 is a second breakout to the next high. If you want to take the A2, you can. This is not a very good A2 because the stochastics indicator is still in the middle range. It's not in an extreme down in the low. It's not in the extreme up in the high. It's still kind of dead here. So we kind of really want to see that market pick up a little bit more before we start trading. But nonetheless, that is an A2. You could take that right there, or you could wait for it to go up and have a bigger extreme pullback and call it a B2, all right, or a B1. That would be your second drive. So you're going to look for the A, B, C, D pattern. A, B, C, D. You hear me say it all the time, A, B, C, D land. So this is your A, B, C, get the pullback and the rally out to the next leg. All right. So this is right here, what's happening right now is an A2. And right there, if it continues to rally, we'd expect it to go up, break above that little high right there. Okay. And we'd want it, there's your A2 right there. That's your first pullback against this first green bar, breaking higher. So that's your A1. This is A2. And we're anticipating this thing continuing higher. So if you wanted to get in on this little tiny A2 right here, you could have done that right there and take that position higher. Now, where would be your profit box? Well, the profit box on this would be from where you got in to where you'd get out. So you take your profit box and you say, well, I got in right here. And where am I going to get out? Well, I got to get out not down here. Right now, your profit box is negative because you got your stop set right here, right? You're going to put your stop on the little green dot. So now the little green dot's moved higher. So you're still in a negative profit box. As that market moves higher, keep going, baby. And we'll watch that green dot. So that's called a pennant formation, or a little triangle, or a little wedge pattern right there, a little triangle. We call them pennants because it's tiny. If it's a tiny one, it's a pennant. All right. Okay. Now, as soon as we get a new green dot, which is 27 seconds, see that? We'll get a new green dot on 24, 23, 22. And then that green dot will move. And we're up. How much are we up right now? If we got in right on that A2, we'd be up $165 right now. But are we in a winning trade? No. Why? Because our stop is still back here on the green dot. We wouldn't get out unless the market comes all the way back down and touches the green dot. So there's a new green dot. Okay, we got our new start over, so we can move our stop up to that green dot. Now there's our profit box, which is still negative because we got in right here. We'd get out right here. The market's trading higher. It's actually having a lower high at this point, which is showing weakness. But our stop is back here on the little green dot. This is where you can do a scalp and trail, right? You can scalp one off. You can say, well, I'm up $100, Lan. I'm going to take the $100 if I went in with two. If you only went in with one, then you can scalp out $100 when it starts to show weakness. You watch the little chart in the upper right-hand corner showing weakness, showing weakness. You can see it on the bigger chart here on the main chart. And we're not trading on the dome, so we don't have to deal with that. We're over here, right here on the chart. I can move my stops. I can move them up. I can move them wherever I want, right? Right here on the dome, I can be very, very clean and very clear and very crisp at what I'm doing. If you want to go do this, try and do that on the dome over there, you can do that, but it's a lot harder, in my opinion. So the dome, again, remember, was created back in the day before you could have drag and drop orders. So now we got drag and drop orders. Okay, now we got a new dot. So now our stop is going to go above our entry. So look at that. We finally got to break even. We finally got our order to break even. So our profit box is basically zero at this point. We're going to not lose money, but we're not going to make money. So if this breaks higher, now we got another little triangle formation in there. See that little high coming in there, a little triangle pattern? That would be an A3, right? So if we label these, we can come in here while we're watching. This is A1. This one here is an A2. And then this one here would be A3. We generally only get 3. Doesn't mean it can't get 4, 5, 6, 7, 8, 9, 10. Certainly can. But in this case, this is an A1, A2, and this is a A3. So let's get rid of these arrows. And we're just going to label it and land. Do you do this when you trade? Absolutely. When I'm trading real money, I am so focused, I don't even have text messages coming in. I turn everything off and I label everything. I sit here and I draw these things in there and I label them like just like this. If you go look at my manual, again, if you go look in the book and you look at the examples that are in here, these are examples that I did. If you see in the back of the book, there's some examples. These are actual markets that I actually traded. So I just took screen captures of my day after I was done trading and stuck them in the book. That's how I wrote the book. I was just like, I should probably save this and put it in a book or something. Oh, let's get back over to the software, over to our trade. Hurry, Lane. So our green dot is now right up here. Okay, we just got stopped out. So we got stopped out with a $50 profit. Okay, because that's our profit box. You're like, but Lan, I should have. I wanted to trail on one price bar back. Oh, you did you? Okay, let's say you did that. Well, then your profit box would have been up here, and you'd have got out up here with an $85 profit. Okay. So now we're getting the next step here. We're coming in, that's an A3, which is what we expected to fail, right? So it's acting like a train on rails right now. So it came back and it used its steely knives to do what? Stop us out with it poked those little green dots, right? That's what we expect. And now if it comes up and breaks a new high across this right here, that's our first candle to make a new high right there, right now. That would be a B1, right? So we're going into our second drive, B1. So this would be B1. Now, does it always follow these ABC patterns? These A, B, B, B? No, not always, but a lot, enough to use it as our system to put money on it, right? Okay, we're getting the third one down. So the B1 is pulling back even farther. Let's get rid of this. That means this here, this is our X1, right? So our first exit. So A1 is our entry. We don't generally take A1s because we get lots of false A1s. But when we get an A1 that's way down here in the bottom, when the stochastics is way down here, you're more likely to take it, right? If you're going to take an A1 like this one, you look at that one, you're like, well, that's a new A1, but stochastics is dead center. I don't really want to take it. If it's down in an extreme like that, you're more likely to take an A1. Okay. All right. We're getting ready to go B1. Okay. So here's your B1. So here's your break across the B1 right there. So the first candle to break a new high. There we go. Now we might get that triangle or wedge pattern, right? It might come up and fake and die on us. And then we would have the next one, which we would take our line here and we would draw across the top of those bars. Okay, like that. So now we're coming in with a little wedge pattern, just like that. So there's our wedge pattern right there. So that becomes the wedge, and we're looking for this thing to break out the top of the wedge, right? This bar here is called a clearing bar. So this is a clearing bar. See how it has a little tiny body and a topping tail and a bottoming tail? Generally, the first bar, the first flat bottom or flat top bar after a clearing bar is the new trend. Now, we would expect this to be bullish. If this was a nice parabolic market and we had good news and everything was great, this would just take off and break above this trend line and start to rally. If we have a shitty market, oh, damn it, I just swore again. Now I have to go to confession. If we have a shitty market, now I can swear all I want. Did you say the F word, Lan? No, I didn't. All right. Then we won't penalize you that bad. Okay, another clearing bar. That's nasty. We don't like to see multiple clearing bars in a row. That tells you not to trade. If you get two clearing bars in a row, that means you throw the whole thing out and you start all over again and you wait for a new trend. Okay, because those are nasty time frames. You don't want to trade clearing bars. So now we're getting a new flat top. So again, got clearing bars. We can wait and see what's going to happen. This is actually bullish. We're supposed to be getting a bullish trend, right? A, B, C, and now this market's supposed to rally back up. If it doesn't do that, it's not a market you want to trade. But Lan, take it short. Okay, you can do that. But let's be systematic about it. Let's be systematic about it. Do your swag, scientific, wild ass guess. Be scientific about your wild ass guesses. Let's be as scientific as we can. All right, so now we have a down arrow. The down arrow is telling us that the market has changed from bullish to bearish. Now, sometimes that's why we have a Fibonacci ruler, right? Markets like to come back because traders think that this is important. They'll draw their Fibonacci ruler on there, and then they'll anticipate a market coming back into the what I call the Fibonacci sweet spot between 38.2 and 61.8. So if it's going to do that, we've broken out the bottom of the wedge pattern. We've failed to make our ABC. So our ABC has failed. It could still make an ABC. It could just, I mean, obviously, let's send this to the back, send to back. And we're going to bring this in here. And it could come down and make your ABC here. Now it's coming down. It's touching 50%. Remember, Fibonacci sweet spot between 38.2, 61.8, right there. 61.8 is the golden ratio. So a lot of traders will anticipate that the market coming down to 61.8. 50% is also an extremely popular number. So they'll drive it down to 50%. This is where a lot of traders will step in and start to buy in anticipation of this ABC coming up here. And so you'll start seeing buyers placing limit orders to take long positions along these Fibonacci numbers. They'll do what I call the Fibonacci Christmas tree. So they do something like that. And as the market comes down, bam, they pick up one, they pick up another, they pick up another, they pick up another, whether it's a single quantity or 10 quantities, or you look out on the ladder, you'll see 10,000 quantities, and those are usually fake. All right, those are fake. So that's what's trying to draw the market down so they can take long positions. Because if they put a whole bunch of big orders down here, if they come in here, and they put 100 orders in here, and they drop that on there, 100 contracts, everybody's going to think, oh my gosh, that guy thinks that the market's going to fall from there, and so they're going to drive the market down, thinking that they're going to go down and catch up with that 100 guy short position. Really what he's doing is he's got a hidden order to go long right in here. You help drive the market down to pick up his better price, and then he pulls off the 100, and then he's long with his maybe 10 going the other way. All right, so that's called spoofing. So that's how the market gets pulled back to those levels oftentimes. If you go look on the spoofing machine, then that's what happens. Okay, so if you buy in at the 50%, the market's starting to rally, or if you wait until it breaks above the previous high, and that's the first green candle to break a new high, there's your signal for entry right there. So you can get in right there on that first candle to break a new high, which is that natural trend line. And if you come in again over to our little picture, it almost looks like it's straight out of the manual, doesn't it? Look at that. Came right back down, got us the little spiky, which we come in here, we call that the spring, and that's what's hitting the 50%. That one touched the 50%, and now it's turning and starting to rally once again. So it's this exact pattern, isn't it? Up, pull back, up again. And it didn't do this one. This one failed on us, and so it got the little bit farther back one, which is this one here, and you get the little triangle. Now I've got drawn in here on this one, you can see I've got multiple trend lines. You got a natural trend line, you got a mathematical trend line, which crosses over where in our case, we're looking at green dots, and then you got the horizontal, which comes across at an equal level. That's called my spider web. So you come in here. So we're going to see if this market won't continue higher. It's a little weak. Notice the MACD is, these little curls on the MACD are small. They're not as, and that's comparative to the previous trend. So see how much higher this one was versus this one. That just shows a really weak market. This is really weak compared to what's here. So you look at what this one was, and you're like, well, was that tradable? Yes, it was. Okay, barely, because we saw that our profit box is relatively small, even with that trend right there. So you look at this one, and you say, well, these are smaller than that one, and this one was hard to trade. Well, that one's going to be even more difficult to trade. Okay, so you can look at the MACD to try and help you see the strength of the trend comparison to the previous trend. And that's why that MACD does that. Watch this. Because if you shrink it down, the MACD will move. Watch this. See that? See how it's moving right there? See the MACD changing sizes? That's because it's a comparative indicator. It compares. See, well, there's a big move in it. See that? See how the MACD changes? You're like, wait a second. Why is it doing that? It changes because it's on a relative scale. So the reason you use a tool, notice the stochastics that's laid over the top of the MACD. The MACD is the one that's red and green right here that's moving. This is volume down here. So as I move that back and forth, you can see the MACD scales against itself. See that? It's scaling against itself because what you're doing is you got to use that to help you identify whether a trend is as big as this trend or not. So this one here is not as strong as that one. So if you had a hard time trading this one, you're going to have a harder time trading this one. All right. That's what that's telling you. It's a relative scale relative to what the market's been in the past. Okay. So can it change? Yeah, of course it can change. So here we go again. So how are we going to read this? So we had a false breakout here. We had a false breakout here, pulled back down. First candle to make a new high right there. First green candle to make a new high. Stochastics dead center. MACD's coming down. I don't really want to take that trade. I'm going to wait. Now it could go. It's that pattern, right? It looks just almost right straight out of the book of this pattern. It could go. If you wanted to take it in anticipation that they're going to run this market, do you think a lot of people are going to jump on this thing and run it right now? Do you think a big institution is going to run it right now? What is the psychology that people are thinking? Are they going to jump on this thing and go? If they are, you could put a position on there. There's not much risk. Your stop would be if it broke that green bottom right there. So you can come in here and you can say, okay, I'm going to go in with it. And I'm going to put my stop right here. So I'm going to just take a small risk to see if that thing's going to go. It should go. Traditionally speaking, the pattern is that we're breaking these natural trend lines. It should go. If it doesn't, I'm just going to get right back out. I got a flat bottom right here. That's my risk. So my risk is just a small risk between where I get in and where I get out. It's right there. It's $30. So I'm going to risk $30 to see if this thing's going to break and go higher at this point. Now, if you have more confidence, you can use larger quantities, but it also depends on your spreadsheet, right? Where are you at on your spreadsheet? How big are you allowed to trade? Your goal is $98. So your goal for a day is $98 in this case because we are doing a small account challenge and we're trying to make 1%. Okay, we just got stopped out. See that? It didn't go. It didn't go. It didn't do what it was supposed to do. And so all the signs were telling us probably a weak market, first of all, right? MACD was telling us weak market. Now it pulled back, stopped everybody out because we weren't the only ones that thought that would be a good idea. And now it's turning and going. So that linebacker came back and got us right there, little bastard. So you want to try it again? You can try it again. You can say, well, now he's going to go. Okay. Now I'm going to put my stop at the same spot and see if he's going to go this time. It should go, right? If we had any kind of energy in this market, which is pretty sad, we don't have a lot of energy in this market. MACD starting to curl. Again, do you want to take a big risk? No. Where? Well, it's starting to die on us. We don't want to hold it so close that it can come back and stab us out like it just did before, but we also don't want to take a big risk if it's not going to go. So our goal is just really to get to break even and then look for a longer term trend. But this market just doesn't want to do anything. We just keep losing the money we made on our last good trade. Come on, push it up there, guys. There we go. Now, what's our first goal? Let's get rid of all these drawings. Okay. We've got lots of topping tails, lots of bottoming tails. We're getting flat. We had a nice, smooth, clean rally. We got an ugly pullback, which is usually the accumulation stage, and we should get a nice, smooth rally back out. That's kind of the thing we look for, right? We're not getting the smooth rally back out, though. Market's weak. If we take another loss, we should stop trading because all we're doing is just giving back the money that we're making. And I don't like it. Get out. Take our loss. All right. 3 losers, 3 strikes, you're out. We also play baseball, right? 3 strikes, you're out. You're done. You can't trade again. You can't sit here and trade this pattern any longer. But what about a reversal, Len? I want to take a short. Well, you took your 3 shots at trying to go long. You can't take a short. Now you can't come back until 9 o'clock and trade again. You can't trade till 9 o'clock. That means this much time has to go by. You have 3 strikes, you're out. The inning's over. Now we're going to go to the next inning. Okay. The next inning starts at 9 o'clock, and you can trade there. And you can trade until either you lose 50% of your value, you realize profit. We're up 220. We had 300. If we lose another $50, we have to stop for the day. The game's over. We lost. All right. We didn't really lose because we still got green, but we don't want to sit here and try to make more money and lose all the money we made. So that's our next inning. And then our next inning starts at 10 o'clock. All right. So then our next inning is out here at 10 o'clock. And you can trade until you get struck out. 3 strikes, you're out. 3 strikes, you're out. 3 strikes, you're out. Don't overtrade. Use these restrictions on yourselves. And once you lose 50% of the green that you've got, well, then you got to stop trading for the whole day. The game's over. Go to the locker room. All right. If you'll put yourself into these restrictions so you keep yourself from overtrading, trading too much, and not trading when a market's trending, then you're going to have a greater degree or a greater level of success. And learn how to read the charts, risk versus reward ratios, making sure that you're not overtrading. If you get knocked out, wait for the next inning. Okay. 3 strikes, you're out. And if you start losing all your money, you lose 50% of the green that you've got, you got to stop trading. Game's over. Right? Game's over. All right, guys, I do have a Sunday school lesson for you today. I think that was a pretty good Sunday school lesson in itself, but I do have a Sunday school lesson for you. Let me pull up the Sunday school lesson. Trading is like fishing. There's a lot of waiting and searching for just the right fishing hole. Then throw your line in the water and hope for a bite. I think I did this lesson already. That's all right. Sometimes you catch a small fish, sometimes you catch a huge fish, and sometimes you lose your bait. It's rare to catch the big fish, more likely to catch the small ones, but lots of small fish are still good eating too. I think we did that one yesterday. Let's see what today's Sunday school lesson is. Oh, here we go. Patience is a virtue. Most new traders have patience for losses, but not for winners. Too often traders will get into a trade, the market will move in their favor, and they quickly jump out with a small profit, cutting their winner short. While on the other hand, when the market is moving against them, they'll hang on to losers, waiting and waiting and waiting for it to turn around, causing large drawdowns and losses. The name of the game is to cut losers short and let winners run. Don't let your losers run. Okay. You can have lots of little tiny losers. That's okay, because your big winners will pay for them. But if you take big losses, if you let those markets come down thinking, oh, I'm just going to let it come back against me, I'll just get back. I don't want to get out. That's not a good, that's not how you day trade. All right. Don't do that. Don't do that. All right. It's a good way to blow up your account. So cut your losers short. Let your winners run. All right, guys. That's my Sunday school lesson. If you guys wouldn't mind hitting the little thumbs up if you thought today was a good lesson, if you learned anything. I'm going to come in and say hello to a few guys. We got John David Lundberg in here saying hello. We got Bruce saying hello. We've got Michael Bruce. Good morning, everyone. We got Kim Moss in the room. There we go, Kim. It's nice to see you, Kim. There we got Brian Johnson saying hello. Brian's pointing out that options expiration, perhaps. Yes, sometimes options expirations will cause the markets to move one direction or another. We oftentimes will use strike prices for options as what we call indicator land. Where's your overlay indicator? Overlay chart, overlay indicator, chart overlays as your pivot points. So we have a pivot points indicator, but I oftentimes will like to use, as Brian is mentioning here, I like to use option strike prices as our pivot points. And so that's very important too, but the options in Russell suck. So that would be more of an S&P thing. We could still put them on there and see where the pivot points are though. That's for sure. Absolutely, Brian. So Bruce says he's looking forward to seeing us in the options class on Monday. Awesome. I'll look forward to seeing you there, Bruce. We got Kirk Schwartz in the house. Nice to see you, Kirk. We got Larry McIntosh. Great to have you, Larry. Every day. Love to see you here. And then we've got Gary Thomas. Good morning to all. And we've got John David Lundberg. What about March Madness basketball analogy? Any slam dunks? Well, we had a slam dunk this morning. We had a pretty good slam dunk in there. but mostly we just shot a bunch of foul shots today. And then thanks for the excellent lesson. Glad you enjoyed it. And then triple witching today as well. So Kirk's pointing out the triple witching. If you don't know what triple witching is, Pit News Magazine, last issue, had a whole article on triple witching, along with a couple of other wonderful different strategies. So keep that in mind as well. Triple witching, of course, means that you got expirations of contracts, you got expirations of options, and you got all those coming together at the same time on the same day. So that's what triple witching is. And then you got Michael Bruce, the known unknowns. Absolutely. Known unknowns. Look at that market go. Now that we got out of it, it started to rally. So we had a couple of false starts, but there it started to finally move. Broke above that previous high. Broke above those red bars. Finally got the little break right in here. Had a couple of false starts right in here, which is what we got caught in, right? Now it's starting to finally move. We got another target up in here. All right. All right, guys, I'm going to let you go. We will, pivot points. I like to use strike prices as pivot points. So we've done that in the past. We'll do that again here in the future. We'll try and remember to do that. Okay, guys, I'm going to let you go. We'll see you. See you Monday. Have a good weekend.